there, and welcome to the Property Wealth Podcast. Today, we're diving into a topic that's really been on everyone's mind lately: interest rate hikes and how they impact real estate investors.
Yeah, it's such an important subject, especially for those of us looking to build long-term wealth.
Exactly. I mean, interest rates can really change the game for investors, right? They affect everything from mortgage payments to property values.
For sure. We'll break down what these hikes mean for your investment strategy and how you can adapt to stay on track.
And we'll also talk about some practical steps you can take, no matter where you are in your investing journey.
Plus, we'll share some tips on finding opportunities even in a changing market.
So, if you're feeling a bit anxious about the current landscape, don't worry. We've got some solid advice lined up for you.
Absolutely. Let's get into it and help you navigate these waters with confidence.
Right. So, Mike, let's start by breaking down what exactly happens when interest rates rise. How does that trickle down to us as real estate investors?
So, Sarah, with everything happening in the economy right now, interest rate hikes, they really have this ripple effect, It's not just about borrowing costs. It's about how they influence everything from property values to rental income.
Absolutely, Mike. And for listeners over 40, this is a critical juncture. Many are starting to think about their retirement timelines, right? They're asking themselves, how can I ensure I have enough to live comfortably?
Right, and real estate can be such a solid part of that strategy. But with rising rates, it's important to stay informed. For instance, I had a client, let's call him John, who was considering buying a rental property last year. When rates were lower, he was excited about the potential cash flow. But as rates climbed, he hesitated, thinking, will this still be a good investment?
That's a common concern. It's like the market shifts are making people second-guess their decisions.
Exactly. But here's the thing. John eventually decided to go for it anyway. He did his homework, found a property in a growing neighborhood, and even though his mortgage payments are higher now, the rental demand was so strong that he's already seeing a positive cash flow.
That's a great example. It really highlights the importance of understanding your local market dynamics, right? It's not just about the interest rates. It's about the demand in your area.
Totally. And that's especially key for those over 40. They're often looking at real estate not just for cash flow, but also as a way to protect against inflation. When the cost of living goes up, having a solid real estate investment can really help maintain your purchasing power.
Yeah, and it's that sense of security that's so important, especially as people start thinking about wealth transfer to their families. They want to leave something behind that will benefit their children or grandchildren.
Exactly. I spoke with a couple, let's call them Linda and Tom, who bought a duplex to create a legacy for their kids. They viewed it as not just a financial investment, but as a family asset that could generate income and appreciate over time.
And that's so powerful. It's like they're building a financial foundation for the next generation.
Right, and they're also aware of the shifts in the market. They chose that duplex in a neighborhood that's revitalizing, knowing that despite the interest rates, the long-term appreciation potential was strong.
So they're focusing on the bigger picture, even amid these economic challenges. That's a key takeaway for our listeners, I think. Look beyond the current rates and think about where you want to be in 10, 20 years.
Absolutely. And, with the volatility we've seen recently, it's natural to feel anxious. But that's where having a solid strategy comes into play.
Right. It's all about being proactive rather than reactive.
And that's crucial for anyone over 40. They're often in a phase where they want to be more strategic with their investments. They may not have the luxury of time that younger investors do.
For sure. Speaking of time, many listeners might be wondering how to navigate these changing economic trends.
Well, one thing I often recommend is diversifying your real estate portfolio. It could mean investing in different types of properties or even exploring markets outside your current location.
That makes sense. Expanding horizons can help mitigate risks.
Exactly. And let's not forget about the emotional side of financial security. Real estate can provide that peace of mind, knowing you have something tangible.
For a lot of people, it's not just about the numbers. It's about feeling secure.
I had another client, a woman we'll call Maria. She was nearing retirement and felt overwhelmed by the uncertainty of the stock market. She decided to sell her underperforming stock investments and reinvest that money into a rental property.
And how did that work out for her?
Really well. She found a condo in a desirable area, and now she has consistent rental income coming in. It's given her more confidence and security as she approaches retirement.
That's inspiring. It's a good reminder that real estate can be a stabilizing force.
And as we've seen recently, markets can be unpredictable. But having a reliable rental property means you have a steady stream of income, even in times of economic uncertainty.
I think that's especially important for those planning for retirement. You want to create a cushion for yourself, right?
Exactly, and the added bonus is that real estate often appreciates over time. So while your cash flow is important, the long-term value can really contribute to your overall wealth.
Yeah, it's like a dual benefit, immediate cash flow and long-term appreciation.
Right, and for those over 40, understanding how to balance those two aspects can be key to building lasting wealth.
So many factors to consider, but it's all about taking that first step, making an informed decision based on your own circumstances.
Absolutely. And for anyone feeling hesitant, remember it's normal to feel uncertain in today's market. But with the right strategy, investing in real estate can still be a smart move.
Well, with that in mind, let's dive into some core strategies to help navigate these interest rate hikes effectively.
So when we're talking about interest rate hikes, it's crucial to have a few strategies in your back pocket. One of the first things I always recommend is understanding the 1% rule.
Right. The 1% rule, that's where you want to aim for the rent to be at least 1% of the property's purchase price each month, right?
Exactly. So if you're looking at a property that costs, say, $200,000, you'd want to see it generating at least $2,000 a month in rent. It helps you quickly gauge if a property could be a good investment.
That makes sense, but what if the market's a bit steeper and rents are lower?
Well, that's where you need to dig a little deeper. Look at the local rental market. Sometimes, a property might not hit that 1%, but if it's in a growing area, it could appreciate more over time, making it worth considering.
So, it's not just about that one rule. It's about the bigger picture, too.
Exactly. And another great rule of thumb is the 50% rule, which is about estimating your operating expenses.
Right, that's the one where you take your gross rental income and assume that about half will go to expenses, right?
Yes. So if that same property is bringing in $2,000 a month, you'd estimate around $1,000 for expenses. That includes maintenance, property management fees, insurance, and things like that. It gives you a clearer picture of your cash flow.
And that cash flow is so important, especially with rising interest rates.
Absolutely. Speaking of cash flow, let's talk about cap rates. It's another important metric. The capitalization rate helps you understand the return on an investment property.
So how do you calculate that?
It's pretty simple. You take the net operating income, your income minus expenses, and divide it by the purchase price. For example, if your property has a net operating income of $24,000 and you bought it for $300,000.
That would be an 8% cap rate, right?
Right. So that's a solid return. Generally, you want to look for cap rates that are competitive for your market. Higher cap rates often mean higher risk, but potentially higher returns too.
That's a good point. And when interest rates rise, we could see cap rates adjusting as well, right?
Exactly. Investors might demand higher returns to offset the increased borrowing costs. It's all interconnected.
So how do you evaluate a deal overall?
Well, I like to use a checklist for evaluating properties. Start with location. What's the neighborhood like? Are there schools, parks, and amenities nearby?
So important.
Then look at the numbers. What's the price, potential rent, and expenses? After that, consider the property condition.
Right, you don't want to jump into something that needs a ton of work unless you're prepared for it.
Exactly. And then factor in your financing options.
Financing can really change the game, especially with interest rates fluctuating.
For sure. If you can get a fixed-rate mortgage, it might be worth it even if rates are higher now, since you lock in that rate for the long haul.
That's a good strategy.
On the flip side, some investors might consider adjustable-rate mortgages, especially if they're planning to hold a property for a short time.
But that comes with risks too, right?
Definitely. If rates go up, your payments could increase significantly. That's why it's essential to have a solid exit strategy.
And what about different property types? Are there certain types that are more resilient during interest rate hikes?
Generally, multifamily properties tend to hold their value better. People always need housing, you know? Plus, they can have multiple income streams.
So even if one unit is vacant, you still have others bringing in income?
Exactly. Single-family homes can be great too, but they might be a bit more susceptible to market fluctuations.
That's good insight.
And let's not forget about commercial real estate. It can be a great hedge against inflation, assuming you've got solid tenants.
Right, because businesses often look for long-term leases, which can provide more stability.
Exactly. But that's a bit more complex and requires a different level of market knowledge.
So it sounds like there are a lot of angles to consider, especially with rising interest rates.
Yeah, and that's why having a strong team is key. Real estate agents, property managers, and financial advisors can help guide you through the complexities.
Definitely. But while we're on the topic of complexity, let's touch on some common pitfalls investors can fall into during times of rising interest rates.
Ah, good idea. One of the biggest ones is not adapting your strategy.
Right? Just because you had success before doesn't mean the same approach will work now.
Exactly. And underestimating your cash flow needs.
That could be a disaster, especially if an unexpected expense pops up.
For sure. And another pitfall is not doing your due diligence on financing options.
So it's crucial to shop around and understand your options, especially with how quickly things can change.
Absolutely. It's all about being informed and flexible in your approach.
Well, I think that gives our listeners a lot to think about.
Yeah, it's a challenging landscape, but with the right strategies, they can navigate it successfully. You know, Sarah, when we talk about interest rate hikes, one of the biggest pitfalls I see investors fall into is over-leveraging.
Oh, definitely. It's like they get so excited about the potential returns that they forget to consider how much debt they're actually taking on.
Exactly. I once worked with a client who bought a property with a high loan-to-value ratio, thinking, this is going to be my golden ticket. But when interest rates went up, their monthly payments skyrocketed.
Ouch. That must have been a tough lesson.
It really was. They struggled to keep up and soon found themselves in a position where they couldn't even cover their mortgage payments, let alone any repairs or other costs.
That's a classic example of how important it is to have a solid financial buffer, right?
Absolutely. You need to have a clear understanding of your cash flow before diving in. And speaking of cash flow, I think another common mistake is ignoring it altogether.
Yes. I mean, it's easy to get caught up in the excitement of a property's appreciation potential, but if the cash flow isn't there, it can lead to disaster.
Right. I remember another case where someone bought a rental property in a hot market, but the rent didn't cover the mortgage and other expenses. They thought they could just raise the rent later.
But then what happened?
The market shifted, and they found themselves stuck. Tenants weren't willing to pay higher rents, and the investor ended up digging into their savings just to keep the place afloat.
That's so stressful. It's like a snowball effect, right?
Exactly. And then there's the issue of bad tenants. That can be a real headache too. People sometimes think, oh, I'll just take the first applicant. But that can backfire.
For sure. I had a friend who did that. She was so eager to fill her vacancy that she didn't do a thorough background check.
What happened?
Well, the tenant turned out to have a history of late payments and was difficult to communicate with. It ended up costing her more in the long run.
That's such a tough lesson. A bad tenant can really eat into your profits, not to mention the stress it brings. It's crucial to vet applicants properly and look for red flags, like inconsistent employment history or multiple evictions.
Yes, and I think it's also important to be aware of hidden costs. A lot of investors underestimate things like maintenance, property management fees, or even unexpected repairs.
That's right. I've seen it happen where someone buys a property thinking it's all about the purchase price and the mortgage, but then they're blindsided by how much it costs to keep the place running.
Like the time I heard about a guy who bought a fixer-upper, thinking it would be a simple renovation.
Oh, those can be tricky.
Yeah. He didn't factor in the plumbing issues or the roof repairs that popped up after he moved in. It turned his affordable investment into a money pit.
It's a painful reminder that due diligence is key. Always get a thorough inspection and budget for those unexpected costs.
And don't forget about timing the market.
Oh, that's a big one. I've talked to investors who try to time their purchases based on market trends. They'll say things like, I'm waiting for the market to drop before I buy. And then they just end up waiting and waiting.
Exactly. The market is unpredictable, and trying to time it can lead to missed opportunities.
I once had a client who waited for what they thought was the perfect moment. By the time they were ready to buy, prices had already escalated, and they ended up paying way more than they would have if they had acted earlier.
It's so frustrating. It's like a game of chicken that nobody wins.
Right? Instead, it's often better to focus on finding a property that fits your investment strategy rather than trying to catch the peak.
So with all these pitfalls in mind, how do investors protect themselves?
Great question. First, they should always have a solid financial plan in place. This means understanding their cash flow, budgeting for hidden costs, and being conservative with how much debt they take on.
And what about tenant screening?
Definitely prioritize thorough tenant screening processes. Look for applicants with stable incomes and solid rental histories.
And I'd add that it's crucial to build a relationship with reliable contractors or property managers. It makes handling repairs and tenant issues so much smoother.
Yes, building that network can save you a lot of headaches down the line.
So it sounds like being proactive is key?
For sure. And if you do find yourself in a tough spot, the best thing is to assess the situation realistically. Sometimes it's about making tough decisions, like whether to sell or hold on to a property that's not performing.
Right. And having a clear exit strategy can help with that too. It's all part of being prepared.
Exactly. And remember, every investor makes mistakes. It's all about learning from them and adapting your strategy as you go along.
Well said, Mike. So for anyone listening who may be feeling overwhelmed by the current market conditions, just keep in mind that it's possible to recover and make informed choices moving forward.
Absolutely. And don't hesitate to reach out for support or guidance if you need it. It's all part of the journey.
And with that, let's transition into some next steps that our listeners can take to enhance their investing strategies and avoid these common pitfalls.
So now that we've talked about interest rate hikes and their impact, let's get into some practical steps you can take right now to navigate this landscape.
Absolutely. It's all about taking action, right? What's the first thing you'd recommend?
Well, first off, I think it's essential to start by analyzing your current situation. Take a good look at your finances. Do a deep dive into your income, expenses, and any existing investments. You can use apps like Mint or YNAB to help track your finances, and that's a great starting point.
That makes sense. And once you have that clarity, what's next?
Next, I'd suggest getting familiar with the market. Websites like Zillow or Redfin are great for browsing properties and checking out the trends in your area. You can see what homes are selling for and how long they're staying on the market. This really helps you get a feel for your local real estate landscape.
Right, and that can help you identify potential investment opportunities?
Exactly. And if you're looking at specific properties, tools like the Bigger Pockets Calculator or Deal Check can be invaluable. They let you analyze cash flow, ROI, and other metrics. You can run the numbers and see if a property is worth pursuing or if it's better to pass.
I love that. It's so important to have those numbers in front of you. But what if someone is just starting out and feeling overwhelmed?
Well, I'd say start small. Like, maybe commit to analyzing one deal a week. Just pick a property, run the numbers, and see what you come up with. It doesn't have to be a huge commitment, but it will build your confidence over time.
That's a really approachable way to get into it. And what about connecting with others?
Great point. Joining local meetups or real estate investment groups can be a game changer. You can learn from others' experiences and share your own insights. Plus, you get to network, which can lead to partnership opportunities down the line.
Networking really does open up doors, doesn't it?
Absolutely. And don't forget about online resources. Podcasts like Bigger Pockets Podcast or The Real Estate Guys are fantastic. They provide a wealth of information, and you can listen while you're commuting or doing chores.
Oh, that's perfect. It's like turning that downtime into productive time.
Exactly. And there are also some great books out there. The book on rental property investing by Brandon Turner is a classic. Or Rich Dad Poor Dad, if you haven't read it yet. It's foundational for understanding wealth-building principles.
Those are great recommendations.
And don't overlook your local MLS Access if you can get it. That's a powerful tool for tracking listings and understanding market dynamics.
So much to explore. What about tools for managing properties once someone decides to invest?
Good question. Property management software like Buildium or Tenant Cloud can simplify things. They help with tenant screening, payment processing, and maintenance requests, which can save you a lot of headaches down the line.
Wow, that sounds super helpful.
It really is. And, as you get more comfortable, consider setting up a system for continuous learning. Maybe dedicate an hour every week to read articles, watch videos, or listen to podcasts.
Consistency is key, huh?
Definitely. And remember, it's all about starting where you are. You don't have to have it all figured out. Just take that first step and build from there.
That's such an encouraging perspective.
And lastly, don't forget to stay informed about the economic climate. Subscribe to newsletters or follow financial news outlets. Understanding the broader economic factors can help you make more informed decisions.
Such practical advice. So with all these tools and habits in mind, I feel like our listeners are really set up to take action.
Yeah, absolutely. With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. Well, Sarah, as we wrap up this episode, I think it's important to highlight a few key takeaways about how interest rate hikes can really impact investors, don't you think?
Absolutely, Mike. One of the big points we discussed was recognizing that while rising interest rates can increase borrowing costs, they can also create opportunities, especially for those willing to adapt their strategies.
Right, and that leads us to the idea of cash flow management. Keeping an eye on your expenses and ensuring your properties can still generate income is crucial during these times.
Exactly. And let's not forget the importance of doing your homework. Understanding the market trends and how they affect property values. Knowledge is power, especially now.
Definitely. And it's also a good reminder about diversifying your investments. Being flexible and considering different types of properties or locations can really help mitigate risks.
Yes! And as we've mentioned, long-term thinking is key. Real estate is a journey. And while there may be bumps along the road, sticking to a solid plan can lead to great rewards in the end.
Well said, Sarah. Building wealth through real estate isn't just about the numbers. It's about creating a legacy and a future for yourself and your family.
Absolutely. So if you found value in today's conversation, don't forget to like, subscribe, and share your biggest takeaway or any questions in the comments. And hey, if you know someone over 40 who's interested in investing in property, share this episode with them.
Yes, please do. We want to help as many people as possible on their investing journey.
And just a little teaser for our next episode, we'll dive into the topic of when to sell your rental property.
That's right. It's going to be a great discussion, so stay tuned for that.
Thanks for joining us today, everyone.
Take care and happy investing.